Good morning. Thank you for joining today's daily webinar where we go over your daily questions and over certain topics. Today's topic is, can I transfer a former employer 401k loan to a solo 401k plan? The answer is yes. You can certainly transfer a former employer loan, such as a loan from a former employer 401k, 403b for that matter. That type of loan can be transferred to a solo 401k plan, provided the solo 401k plan allows for 401k participant loans. We're going to go over some of those rules. Before we go over those rules, keep in mind that today's presentation is for educational purposes. We are not going to be providing investment or tax advice today. Let's see here. Now, let's first talk about the general type of 401, whether it's a loan you process from a solo 401k or a traditional, aka full-time employer 401k. So the loan limit is typically 50% of your balance, not to exceed $50,000. For example, if the value of your 401k is $150,000, the maximum you can borrow is $50,000. On the other hand, if the value of your 401k is, let's say, $80,000, the maximum you can borrow is $40,000. The 401k participant loans are generally paid back over a 5-year period, and the payments are made in level payments, either monthly or quarterly, over that 5-year period. Now, if you use the proceeds of that 401k loan for the purchase of your primary residence, so towards the purchase of your primary residence, then that loan period can be extended to 15 or even 30 years, depending on your mortgage terms. So that's known as the primary loan exception, where you can extend the loan from 5 years to 15 or 30 years. Okay, so again, if you have a former employer 401k plan and you have an outstanding loan in that 401k plan, and now you want to open a solo 401k plan, or you already have a solo 401k plan, then you can transfer that former employer loan through that 401k. That can be transferred to the solo 401k, provided that the solo 401k that you open allows for participant loans. Now, not all former employer plans will allow the outstanding 401k loan to be transferred out. That's a restriction that they may have placed on that 401k. But that doesn't mean that you still cannot get that loan transferred from that former employer 401k or 403b to a solo 401k plan. The way to do that, if they will not allow you to transfer it, is through what's called a 401k participant loan offset. What is a participant loan offset? Well, when you leave your employer, so you separate from service, or maybe you got laid off, and if you have an outstanding 401k participant loan and you can't afford to pay back that loan, or you just don't want to pay back due to you don't want to tie up your funds, you need to use those funds for other purposes, for instance, then that outstanding loan balance may be offset by the remaining funds in your 401k participant account through that daytime employer 401k to pay off the loan. Now, the loan offset will be considered an actual distribution, even though the participant does not receive any actual funds. So therefore, federal taxes and the 10% early distribution penalty may apply if you are under age 59 and a half, unless you roll over the offset amount to an IRA or even to a solo 401k plan. And you have to do that by a certain deadline, which we'll go over here below in a moment here. So what's the deadline to roll over the participant loan offset amount? Well, in order to avoid having to pay taxes and penalties on the outstanding participant loan balance at the time of separation from that former employer, the loan offset amount, that is the outstanding loan balance, has to be rolled over to an IRA or another qualified plan, such as a solo 401k plan. And it's got to be done by your personal Form 1040 tax return due date, including extension. So by October 15, and of course, you're not required to file a personal tax return extension in order to be able to do that rollover of that offset amount by October 15. Let's go over an illustration here. Let's say Jake works for the Boeing company and he decides to no longer work at the Boeing company. So on July of this year, 2025, he has 80,000 in that Boeing 401k, as well as a 20,000 outstanding 401k participant loan in the Boeing 401k. And Jake can't come up with that with 20,000 to repay that outstanding 401k participant loan. But he still wants, well, what he would do is he would submit transfer instructions to Boeing to have that $80,000 directly rolled over, transferred to his self-employed, aka solo 401k plan. Now, the administrator of the Boeing 401k was going to proceed by first offsetting that $80,000 plan balance by that 20,000 outstanding participant loan balance. So he's going to end up transferring only $60,000 to his solo 401k plan, so $60,000 in actual funds. Now, while Jake did not receive the 20,000, which was that 401k participant outstanding loan, he can still roll over that outstanding $20,000 loan amount over to, again, to an IRA or to a 401k if he can come up with those funds from outside his 401k. So let's say he has funds in his savings account or personal checking account. He would roll over that $20,000 from his checking account or savings account over to an IRA, or in this case, to the solo 401k. And he would need to do that by October 15 of next year, so 2026. So as long as he does that, as long as he can come up with that $20,000 of that outstanding loan balance by next year, by October 15 of 2026, he can roll over that 20,000 into the solo 401k or to an IRA. That's what a loan offset means. You use that strategy when the employer will not allow you to transfer the loan directly from that former employer plan to the solo 401k. You go and you do it in this fashion, where through the method we just described, which is known as a loan offset. Come up with that $20,000 by October 15 of 2026 to roll over into a solo 401k or an IRA, then that loan, that 20,000 amount is going to be considered a taxable distribution for tax year 2025. So that loan offset amount, you can't come up with that 20,000, then there's no loan offset. Now, the loan offset is not available if a deemed distribution occurs. What is a deemed distribution? Well, it's when the 401k participant violates the terms of that 401k participant loan. Back to the Jake example, if Jake, who processed that loan from that Boeing 401k, he took a 401k participant loan, if he had defaulted on that loan by not making the scheduled payments, then he would not be able to do the loan offset. He wouldn't be able to come up with that $20,000 and later on by October 15 and move that over to the solo 401k because the loan offset is not available when a loan goes into default. So in short, your loan has to be in good standing or it can qualify for the loan offset. Okay, so hopefully this is some good information for those who are looking to not have to pay taxes on their former employer 401k participant loan when they leave the employer, because for employers don't always allow you to transfer a 401k participant loan. But if they don't, then you can do this through the loan offset. It's kind of a roundabout way. All right, I think we've got some questions here. Take a look at some of your questions here. Again, go ahead and shoot those over. And as always, please like this video as it helps us to get the word out on this important information to other solopreneurs, entrepreneurs, self-employed persons like you. I know that as the number of self-employed person increases every day, and we do appreciate your participation in helping to get this important information to others just like you. Well, let's take a look at some questions here. Got a question here. Signed up with you, opened my Fidelity brokerage accounts, ready to make pre-tax contributions. What are the tax documents for this transaction and how are they generated? Any useful contribution info appreciated. Great question. So there are no tax documents generated when you make a contribution to a solo 401k plan. Only if you were taking a distribution from the solo 401k plan would a tax document known as a Form 1099-R apply. A Form 1099-R applies when you take a distribution from a 401k, or if you process a conversion of pre-tax solo 401k funds or voluntary after-tax solo 401k funds to the Roth solo 401k plan, for example. However, you do report the contributions on your business tax return depending on how your business is taxed. Let me share some information with you on that front. So here on our website, we have reporting contributions. Let me share my screen here. So reporting contributions, here we go. We have a great cheat sheet here that goes over how to report contributions based on how your self-employed business is taxed. So again, this is the page here. I'll send over this link in a minute, where we have it broken down by self-employed entity type. So if your business is taxed as a sole proprietorship, you're going to take a look at this little guide here that goes over how to report those contributions on your tax return. Here's the one for a partnership. Here's the cheat sheet for S corporations. So take a look at this page. We got contribution guides as well with illustrations. Again, let me share this page. I'm also going to share how to make contributions to the solo 401k plan. Specifically, if you used Fidelity Investments or their non-prototype investment only brokerage accounts, which is how Fidelity refers to the brokerage accounts that they open for a solo 401k plan provided by a company like my solo 401k financial. Let me search for that here. You can also search our website for great information like this up on our search toolbox. Let me type in here. So I'm going to Fidelity. Just type certain keywords there. Okay, here's the good one here. How to make solo 401k contribution guide. 7 ways to fund your self-directed solo 401k Fidelity brokerage account. Let me share that with you here. You're going to be able to make those contributions to that Fidelity brokerage account for the solo 401k plan. You can do that electronically by linking your bank account to that Fidelity brokerage account, and you can make those contributions via ACH electronically. So let's scroll. Again, that information is right here on that link I just shared with you, where you link your bank account to the Fidelity brokerage account so you can make the contribution electronically via ACH. The funds will flow from your bank account to that Fidelity brokerage account for the solo 401k plan. There's some good information there. Take a look at that link. Okay. Take a look at some more information here. Got a question here from Van. Let's see here. Can sole proprietorship entity and another LLC with single owner employee both contribute employer contributions to the same solo 401k? Or do I need separate accounts? Self-employed businesses need contributions to one solo 401k plan. Let me pull up some good information on that. Let's do a search here on our search box. Let's type the word aggregate. So here's a good page from our website. Aggregate from multiple sources of self-employment income for making self-directed solo 401k contributions. Well, yes, when you contribute to a solo 401k plan, you are required to base the contribution on all of your aggregated net self-employment income. So if you are the owner of multiple businesses, whether it's a sole proprietorship and then an LLC, that's taxed as an S corporation or a sole proprietorship, you have to aggregate both businesses' net self-employment income to determine the total amount that you can contribute to the solo 401k plan. So it's just one solo 401k plan. So it's not multiple plans. It's not one plan for each owner-only business, but rather just one where you are the sole owner of both businesses. Let me share this link here with you to this page. Now, keep in mind, we also have an artificial intelligence page on our website where you can also ask questions. Let me share that with you as well. We have a lot of good resources at our fingertips here. I just shared the page to our artificial intelligence. That's where you can get some quick questions and get an idea. You can still, of course, communicate with us by scheduling calls, joining our daily webinars, sending us emails. But this is a great tool where you can also, artificial intelligence. It's the first in the industry. The domain is solo401k.ai. Okay, let's take a look at some more questions here. I think that might be it. So again, thank you for joining today's daily webinar. Please like this video as it helps to get the word out of this important information to other solopreneurs like you. The number of self-employed persons increase every day, and we do appreciate your participation in helping to get this important information to others like you. Okay, well, again, thank you for joining today's daily webinar and have a good rest of the day.